Hello, friends. Thank you so much for joining in another episode of Money Minutes with your host, Seema Sharma. Today, we're going to be talking about dollar cost averaging, a concept that is very, very simple. And if you follow that throughout your working life, you would have no issue retiring comfortably. And let me explain why. So most people are scared of fluctuations in the market. They are scared that if I invested my money today, my money may come down. The principal that I'm investing may be lost in the market. And especially nowadays, you've seen a pandemic, you've seen financial market meltdowns, so much that an average consumer has seen in the market. So that fear is very, very real and very natural. So to avoid fluctuations, you need to do dollar cost averaging. Another benefit of dollar cost averaging is you never have to time the market. You turn your fluctuations into great opportunities for your business, for your retirement, for your hard-earned money. Okay. The third thing you want to remember is you don't have to worry about making sure that you have a big lump sum to invest before making a decision of investing. So there are three things that average consumer is scared of. Number one is, would my money be lost or go up and down? Okay. Number two, am I investing in the right time, right market, right situation? Political, economic, social, is this the right time? That's the biggest worry. And third one, of course, is I want to make sure that I don't wait until I have a large sum to invest. So dollar cost averaging in simplest form is basically investing your principal at a given interval, whether that interval is every week, every 2 weeks, every month, every 3 months, regardless. Okay, the shorter the time of the interval, the better it is for your money. But my recommended interval is monthly, because most of us, we budget ourselves on a monthly basis. We want to make sure that at the end of the month or the beginning of the month, if we are investing or saving money, that should be taken out of our account so we don't have access to that money. Okay, let me try and explain the concept of dollar cost averaging and how useful it is for all of us by using this little presentation. I'm going to share my screen with you, and I'll show you how dollar cost averaging works in your benefit at any given time. I hope you can still see me. I'm just right around here. So here we go. I'm going to show you how dollar cost averaging shields your money or protects your money from fluctuation, from the fear of unknown, and also the fear of me not having a big lump sum to invest. Okay, so here in this chart, you'll see I have invested $100 into the market, and I'm investing at a time when the market is, let's say, at an average high. Okay, each unit that I'm buying is $20 per unit. So at the end of the day, how many units I've purchased? I've purchased 5 units. Then the market is taking a downturn, going down. So the unit price is now $10 per unit. So in this $10 per unit environment, I invested another $100, and this time I received 10 units. So total 15 units. Now the market is still going down, and the unit price has come down to $5 per unit. At this time, I am putting another $100, which gives me 20 units. So the total investment that I have done over these three intervals is 100, 100, and 100. So that's $300. And I have purchased units at three different prices: $20 per unit, $10 per unit, and $5 per unit. Now let's say the market comes back up. So anything that goes down has to come back up. And that's what's been happening for the past 120 years if you look at properties or stock market. So anyhow, now the market is coming back up, and this time the unit price has gone back to halfway, which is $10 per unit. You invested $300, you have unit price of $10 per unit. That means you have 35 times 10, $350. That's your earning. So what's your earning? $300 you had invested, and $50 is your earning. All right. If the market comes back up, full swing back to where it started from, then at that point you really have $20 per unit, 35 units, so basically $700. So this diagram basically shows you how in one downturn you were able to more than double your money. All right. I hope you enjoyed this simple concept. There are so many things that we can do to make sure that our money grows and we don't lose it. We need to make sure we invest according to our personality, according to our family and financial circumstances, and also the time horizon and risk tolerance that we can maintain for a long term, especially if you're thinking of investing for retirement. So the simple tip, I hope it helped you. I hope you enjoyed this. And please do comment below if you have any questions so that I can take care of these questions in my next video. If you have any questions or comments, you can also email me at seema.sharma@wefci.com. Thank you and have a great day.